This episode of Homeowners Lab is proudly sponsored by Montana Legacy Insurance, helping families, homeowners, ranch owners, and businesses protect what matters most with trusted coverage and personal service. Also sponsored by HomeManager.io, the smarter way to organize, protect, and manage your home with tools designed for modern homeowners. From insurance insights to home ownership resources, these companies are committed to helping you build, protect, and manage your future with confidence.
Very welcome to the Homeowners Lab, your source for home ownership news, real estate, mortgages, and insurance across America. Helping homeowners stay informed, protected, and prepared for what's next. Real experts, real conversations, real solutions. This is the Homeowners Lab.
So usually when you sit down to play a board game, the rules are, they're printed right there on the inside of the lid.
Right.
Everyone at the table is playing by the exact same parameters. But then you step into the world of home buying, and suddenly the person sitting across from you has this, secret set of rules taped to the bottom of the table.
Yeah, that is incredibly accurate.
I mean, for instance, the Department of Veterans Affairs actually has no minimum credit score requirement.
Yeah.
0. And they have no hard cap on your debt to income ratio either.
Which blows people's minds when they hear it for the first time.
Right. But yet we see veterans and maybe even you listening to this deep dives right now getting denied for a VA loan every single day.
Every day. And it happens simply because borrowers, and honestly, sometimes even real estate agents, they just don't know the difference between a real VA rule and a lender's internal secret rule.
Yeah.
It is the absolute definition of a rigged rule book if you don't know what to look for.
Exactly. And that is why we gathered a massive stack of sources to fix that for you today. We are pulling from VA lender guidelines, underwriter handbooks, and real estate strategy guides.
All of it custom tailored to help you, as veterans, step up and buy your first home.
And our mission for this deep dive is to bypass those hidden traps. We want to arm you with the exact strategies you need to maximize this incredible benefit. Plus, we'll talk about how teaming up with a specialized expert like JC De La Torre can really help you navigate this whole process.
That is such a crucial piece because having someone in your corner who actually understands these nuances is a game changer.
Definitely. So we're going to frame this entire conversation around the life cycle of a dollar in a VA loan.
Yeah.
How you prove you earn it, how the banks try to restrict it, how you use the seller's money to protect yours, and finally, how you defend the physical asset you are buying.
I loved that framework because the VA loan is arguably, it's the most powerful mortgage product on the market today.
Oh, without a doubt.
You're looking at $0 down and no private mortgage insurance. But before you can even start touring homes, you have to prove you are cleared to play.
Right, which starts with the paperwork. Okay, let's unpack this. I was looking through the application guidelines, and it feels like underwriters want a microscopic view of your life.
They absolutely do.
Yeah, I mean, presenting a chaotic piecemeal file to an underwriter feels a lot like handing someone a giant box of flat pack furniture with no instructions and just like a bag of mixed up screws.
That is a very painful but accurate picture. They will eventually figure it out, but it's going to take weeks.
And they're going to keep calling you asking for missing pieces. Right?
Exactly. So if you want a smooth, fast approval, you need to compile a single, neatly organized PDF with your essentials before the lender even asks.
The cornerstone of that is the certificate of eligibility, right? The COE.
Yes, the COE. That proves to the lender that the federal government will actually back your loan. And depending on your service, you prove this with different forms.
Like the DD-214.
Right, the DD-214 for regular veterans, or an NGB 22 or 23 if you're National Guard and Reserves. And if you are currently on active duty, you just need a statement of service from your command.
Okay, so that gets you through the door. And then comes the financial deep dive. The guidelines specify 2 years of W-2s, your most recent pay stubs, and 60 days of bank statements.
Yep, the classic financial trifecta.
I'm really curious about the bank statements specifically. Why a full 60 days? Are they just checking to see if I have the cash to close?
Well, they are looking for cash to close, sure. But more importantly, they're looking for behavioral stability.
Behavioral stability, what does that mean in this context?
It means underwriters use those 60 days to spot unsourced large deposits. If, say, $5,000 randomly showed up in your checking account last Tuesday, they need to know where it came from.
Oh, like if it was mattress money or something.
Exactly. Or if it was a gift from a family member, or worse, a secret, undisclosed personal loan that's going to affect your monthly debts.
Because a new loan means a new monthly payment they don't know about.
You hit the nail on the head. They are also looking for patterns of overdrafts or sudden drops in your financial reserves. It is entirely about proving the stability of your dollar.
Wow. Okay, speaking of stable dollars, the way the VA calculates income is radically different depending on where that money comes from.
It really is.
Yeah, there is this massive distinction between basic allowance for housing BAH and the monthly housing allowance, the MHA, from the GI Bill.
What's fascinating here is how the VA applies what they call a likely to continue test to all incoming cash.
Okay, so how does BAH fare on that test?
BAH is phenomenal for your loan application. It passes the test with flying colors because it is stable, durable income tied to your active service.
It's tax-free.
Yes. And because it's tax-free, lenders do something called grossing up. They can artificially inflate that income by 25% on paper.
Wait, really? 25%. So mathematically, if my BAH is $2,000 a month, the underwriter actually records it as $2,500 of qualifying income.
Precisely. It gives you a tremendous advantage. It drastically lowers your debt-to-income ratio and boosts your buying power.
That is huge.
Yeah.
But then, and this is where I saw a lot of confusion in the sources, we look at the monthly housing allowance from the GI Bill. That trips up a lot of student veterans, doesn't it?
It really does. Your MHA is strictly contingent on you attending classes, and it has a hard expiration date based on your remaining educational benefits.
So it fails the test.
Completely. It fails the likely to continue test. I mean, it's fantastic for keeping your personal budget afloat while you're in school, but the bank won't count a single dime of it toward qualifying for the mortgage.
Man, that's a tough pill to swallow for a lot of folks.
Yeah.
Which brings us to my favorite mechanic of the VA loan, the residual income advantage.
Oh, this is the secret sauce.
Right. Because if the VA isn't strictly relying on a hard debt-to-income cap like conventional loans do, they have to have another way to decide if you can actually afford the house.
And this method is highly borrower-focused. Instead of just looking at the rigid ratio of your debt to your gross income, the VA focuses on residual income.
Which is just the physical cash left in your pocket at the end of the month, right?
Exactly. The cash you have left after your new mortgage, property taxes, auto loans, and credit card minimums are paid.
So they actually want to make sure I have enough cash left over to buy groceries, pay for childcare, put gas in the car.
Yeah, it's not just a blind mathematical ratio. It's a real-world livability test.
That makes so much more sense than just a strict DTI limit.
It does, and it's based on your geographic region and your family size. The VA actually has specific charts detailing exactly how much residual cash a family of 4 in the Midwest needs versus, say, a family of 4 in the Northeast.
So if my debt-to-income ratio is a little high, say over 50%, but my residual income is incredibly strong because I don't have a lot of hidden expenses, what happens?
The VA system will often still approve the loan. It is designed to ensure true, long-term financial stability rather than just punishing you for a high DTI.
Okay, so we've established how you prove your income, and we have the VA's flexible baseline. But now we have to look at how that dollar gets restricted.
The roadblocks.
Yeah, the roadblocks. And these roadblocks aren't thrown up by the VA. They are thrown up by the banks and sometimes even state law.
That's where things get tricky.
Let's start with lender overlays. Earlier, we noted that the VA has no minimum credit score.
But if you call a big national bank today, the loan officer might just tell you, sorry, we require a 620 minimum credit score for a VA loan.
I've heard that exact number thrown around so many times.
Right, but that 620 is a myth, is a lender overlay. It's an extra layer of internal risk management that the bank stacks directly on top of the VA's flexible guidelines.
I always try to wrap my head around the logic here. If the Department of Veterans Affairs is the one guaranteeing the loan and supposedly taking on the risk, why do the lenders get to act like gatekeepers making up their own strict requirements?
Well, if we connect this to the bigger picture of how mortgage-backed securities work, the reality is that the VA only guarantees a portion of the loan.
Oh, it's not the whole thing.
No, typically it's only 25% of the loan amount. The VA isn't handing you the cash, the bank is. So if the loan goes sideways and ends up in foreclosure, the lender still has significant skin in the game for that other 75%.
That makes sense. They use overlays like credit score minimums or stricter DTI caps to protect the cash they are fronting.
Exactly. But the key takeaway for you listening is to recognize when you are hitting a VA rule versus a bank overlay.
Right. So if one lender denies you because your credit score is 615, you don't have a VA problem.
You have a lender problem.
And this is exactly where having an expert real estate professional, someone like JC De La Torre, is invaluable.
Absolutely, because a professional knows which lenders have those strict overlays and which ones don't. You need to seek out a mortgage broker or a specific lender that advertises zero overlays and underwrites strictly to the VA handbook.
A good agent will guide you right to them so you don't waste your time getting denied by a big retail bank.
That is a critical distinction that saves thousands of applications a year.
Okay, so another major restriction comes from spousal rules, which can get incredibly complicated depending on where you live.
Oh, the state laws can be a nightmare here.
Right, so to set the baseline, a civilian spouse cannot use a VA loan entirely on their own to buy a property. The eligible veteran must be on the loan.
Correct. But the real trap seems to be in community property states, places like Texas, California, or Arizona.
Yeah, I was reading how the debt calculations work there, and it almost sounds punitive.
It is a brutal trap. It's born from a clash between state liability laws and federal mortgage rules.
How so?
Well, community property states view any assets and debts acquired during a marriage as equally shared by both partners. So if you live in Texas and you apply for the VA loan just in your name as the veteran, the lender is legally required by state law to pull your non-borrowing spouse's credit report.
Wait, so if my spouse has a hefty auto loan and $50,000 in student debt, that entire monthly burden hits my application?
Yes, every single penny. They must count your non-borrowing spouse's monthly debt payments against your debt-to-income ratio.
Even if they aren't on the loan?
Even if they aren't on the loan. But here's the kicker. The federal VA loan cannot legally attach an unvetted civilian's income to a federally backed mortgage unless they formally apply.
Oh, no.
Yeah, so the underwriter cannot use your spouse's income to offset those debts.
That is insane. You inherit all their financial liability with zero credit for their paycheck.
It is a paradox that could easily tank a debt-to-income ratio overnight.
So what is the actual mechanism to fix that? Because there has to be a way out.
The mechanism is to just add your spouse to the loan as a full co-borrower, assuming they have documentable, stable income of their own.
Okay, so by officially applying together, their income is finally calculated into the file.
Right, and that balances out the community property debt and usually saves the approval.
Okay, that's a relief. While we are on the topic of spouses, I noticed the sources also carve out very specific protections for surviving spouses. This feels like a vital piece of the VA benefit to highlight.
It really is, and it is handled with a lot of care by the VA. Eligible widows or widowers can qualify for the VA loan independently.
And who falls into that eligible category?
Specifically those whose spouses died in service or from a service-connected disability or were listed as MIA or POW.
Okay, and they get the same benefits.
They retain the zero down payment benefit, and crucially, they are completely exempt from the VA funding fee.
Wow, which saves them thousands of dollars at closing.
Exactly.
I did see there are specific age and remarriage rules attached to that, though.
Yes. Generally, if a surviving spouse remarries, they lose the eligibility.
Is there any exception to that?
There is a strict exception. If they remarried on or after December 16, 2003, and they were at least 57 years old at the time of the remarriage, they retain the full benefit.
And they just need to request their specific COE using a special form.
Right. VA Form 261817.
Okay, so we have the loan structure secured. We bypassed the lender overlays, hopefully with the help of someone like JC De La Torre, and we navigated the community property traps.
You are finally ready to make an offer on a house.
Yes. Now we move to the next phase of our dollar's life cycle, using the seller's money to protect your own. Because a $0 down loan does not mean zero closing costs.
Unless you understand how to leverage seller concessions. This is perhaps the most misunderstood and underutilized rule in VA real estate.
Here's where it gets really interesting. The sources describe a two-bucket system for how sellers can contribute to your purchase.
It's a great way to visualize it.
Yeah, I like to think of this like a corporate expense account. Bucket one is your standard business travel expenses. Your hotel, your flight, your rental car. The company covers that completely with no limit as long as it's a legitimate standard cost.
Right.
But bucket two is your entertainment budget. Taking a client out for drinks, ordering room service, maybe buying a nice suit for a dinner. You're allowed to do it, but the company strictly caps that entertainment budget at 4%.
That analogy perfectly illustrates the mechanism. Bucket 1 holds your standard closing costs: title insurance fees, the VA appraisal fee, state recording fees, and lender origination charges.
And there's no cap on those.
There is absolutely no VA cap on how much of these standard costs the seller can pay on your behalf. If the standard closing costs are 5% of the purchase price, the seller can pay all of it.
Okay, so bucket 2 holds the seller concessions. These are the extras.
Exactly.
So mathematically, if I am buying a $500,000 house, my bucket 2 entertainment budget is strictly capped at $20,000.
4%. Yep.
What kind of extras are we actually allowed to put in that bucket?
The rules are incredibly flexible for Bucket 2. You can use that 4% cap to have the seller pay your VA funding fee.
Oh, nice.
Or you can use it to fund a temporary interest rate buydown, which lowers your monthly mortgage payment for the first few years.
That's a huge help right now.
It is. But most impactfully, you can use it to have the seller pay off your personal consumer debts at the closing table.
Wait, let me make sure I'm hearing this right. To fix my debt-to-income ratio.
Yes.
So if I have a $600 a month car payment, I could legally ask the seller to use their 4% concession limit to wipe out my auto loan entirely. Like they just cut a check to the auto lender at the closing table.
You absolutely can, and it is a brilliant strategy for maintaining your long-term financial stability.
That is wild.
Think about how that changes your month-to-month life. By eliminating that car loan, you have instantly freed up $600 a month in actual cash flow.
Which drastically improves your residual income.
Exactly. So when the HVAC unit breaks in year 2, or you need a new roof in year 5, you have the monthly cash reserves to handle it. You aren't left house rich and cash poor.
It sounds almost like a loophole, having the seller pay off your car so you can buy their house. But it's explicitly written into the VA guidelines.
It is explicitly allowed. But, and this is a big but, the execution must be flawless.
Flawless how?
Your real estate agent and your loan officer have to structure the purchase contract perfectly. If they accidentally mix up Bucket 1 standard costs with Bucket 2 extras, and your concessions exceed that 4% cap, the underwriter will reject the contract right before closing.
Forcing everyone to scramble and renegotiate.
Which you do not want. This is another area where relying on an experienced professional like JC De La Torre pays off massively. You need someone who knows exactly how to code these concessions so the underwriter clears them without a second glance.
That is such a pro tip. Which brings us to the final phase, defending the physical asset.
The final stretch.
Right. The offer is accepted. The seller is paying off your consumer debt with concessions. The final bosses of your home buying journey are the underwriter and the VA appraiser.
Yes, the appraisal phase causes a lot of anxiety.
I was looking at the handbook, and it seems like the VA appraisal isn't just about establishing the financial value of the home. It serves as a strict safety inspection, too.
That's right. The home must meet minimum property requirements, or MPRs.
Minimum property requirements. Okay.
The foundational rule is that the home has to be safe, structurally sound, and sanitary.
What are the specific red flags the appraiser is looking for that would actually kill a deal?
They are looking for hazards that threaten the livability of the home. Peeling paint on homes built before 1978 is a major one because it is a severe lead paint hazard.
Makes sense. What else?
Missing handrails on staircases with 3 or more steps, exposed electrical wiring, active roof leaks, or evidence of pooling water in a crawl space.
Okay, so real safety issues.
Exactly. And if the appraiser flags these MPRs, the seller must physically fix them before the underwriter will allow the loan to close.
I can see how that causes friction. I mean, in a highly competitive seller's market, a seller doesn't want to deal with a buyer demanding they install a handrail or hire a painter to scrape windowsills.
They really don't.
Doesn't this put veterans at a disadvantage compared to conventional buyers who can just waive inspections?
It absolutely causes friction, and it is a very real challenge when you are competing against multiple offers. But this raises an important question about the VA's underlying philosophy.
Which is?
Remember that $0 down payment. When you put 0 down, you have 0 equity on day 1.
Right.
The VA wants to ensure you aren't pouring all your limited cash into buying a literal money pit. If you move into a house with a failing roof and no cash reserves to fix it, your financial stability is destroyed immediately.
So the MPRs are designed as a protective shield against catastrophic liability in your first year of homeownership.
Yes. It's frustrating in the moment, but it's ultimately defending the asset and your residual income.
Okay, so let's say we've cleared the appraisal. The handrails are fixed. How do we guarantee the deal actually closes on time and we survive the final underwriter review?
It comes down to speed and strict financial discipline.
Discipline. Tell me more about that.
Well, when the underwriter asks for a final document, maybe a photo of the completed handrail repair or an updated pay stub, you respond within 24 hours.
Keep the momentum going.
Exactly. And more importantly, you must maintain your financial profile exactly as it was when you were initially approved.
So don't drain the savings account.
No.
And definitely don't go to the hardware store and open a new store credit card to buy a refrigerator the week before closing.
That is the #1 mistake buyers make. I cannot stress this enough. Even a single hard credit inquiry for an appliance purchase can alter your debt-to-income ratio at the final hour.
Oh, well, just an inquiry.
Just an inquiry. The underwriter will pull a soft credit refresh right before closing, and if they see a new payment, it can completely kill the loan.
That is terrifying.
It is. Maintain your reserves and freeze your spending until the ink is completely dry and the keys are literally in your hand.
So what does this all mean? We've traced the complete life cycle of a dollar through the VA loan process. We started by proving you earn it, securing that COE, organizing the document file, and leveraging the magic of residual income.
We covered a lot of ground.
We did. We explored how banks restrict it, exposing the myth of the 620 credit score overlay and navigating the community property traps for spouses. We learned how to protect your dollars by mastering the 2-bucket system and the 4% seller concession rule.
Which is such a powerful tool.
And finally, we defended the asset by clearing the NPR safety checks and maintaining discipline through final underwriting. Oh, and we highlighted how crucial it is to have an expert like JC De La Torre guiding you through the maze.
When you pull back and look at all those pieces working together, you realize that the VA loan isn't just a standard path to homeownership. When you utilize the mechanics correctly, it is one of the most powerful wealth-building tools available to any American.
It really is. But before we let you go, we want to leave you with one final provocative thought to explore on your own.
This is my favorite part.
Everything we talked about today was focused on you buying a house.
Yeah.
But what happens down the road when you get PCS orders or your family grows and you need to sell?
This is where the long-term value gets truly fascinating. VA loans are assumable.
Meaning what exactly?
It means that if you lock in an ultra-low VA interest rate today, and you go to sell your home 5 or 10 years from now when market rates might be significantly higher, you can potentially pass your exact mortgage with that ultra-low interest rate directly onto the next buyer.
Wait, the buyer gets my exact interest rate?
Yes. And the truly remarkable part, that buyer doesn't even have to be a veteran to assume the loan.
Think about the leverage that gives you. Imagine selling a house with a 3% interest rate attached to it in a market where the going rate is 7%. That completely changes the math on the resale value of your home.
It makes your house infinitely more attractive and affordable than the exact same house down the street.
It is a massive selling feature, a built-in marketing advantage that most people don't even realize they have in their back pocket.
Absolutely.
So as you step up to the table to play this game, remember, you do not have to play by the secret rules taped to the bottom of the table.
You know the real rule book now.
Thank you for joining us on this deep dive. Get your paperwork organized, partner up with a pro who knows the ropes. Go find a zero overlay lender and confidently go get those keys.
This episode of Homeowners Lab is proudly sponsored by Loan Depot and Juan Carlos JC De La Torre, trusted loan consultants serving Las Vegas and beyond. Whether you're buying your first home, refinancing, exploring renovation financing, or planning your next investment, JC brings knowledge, experience, and personal guidance every step of the way. Connect with JC De La Torre today at 725-229-7117 or email jtorre@loandepot.com to learn more about your home loan options. NMLS number 1098316.